In today's video, we talk about a topic that is very dear to my heart. We talk about the backtests and the biases people introduce in their backtests. I see those mistakes made every day in academia and in industry. Even though a backtest can be right in the code base, it can still be very wrong in reality. And I want to show you guys how people inflate their Sharpe ratios and show Sharpe ratios of 2.53, even though in reality that strategy is just not tradable. Hidden biases, such as the ones I'm introducing to you in a second, lead to real life money losses, even though they look very good on paper. Today we talk about the biggest backtesting mistakes people do and people make. And I also show you real life examples and show you guys how to neutralize them using the code base that we built. If you fix those biases, your results probably get worse, but on the other hand, way more trustworthy, and you know if your strategy actually works. We have to be very careful that we're not chasing the highest Sharpe ratio in our backtest. We don't want to introduce fake alphas. If your equity curve is very smooth and only points upwards, it's probably a sign that your backtest is not correct and you have introduced some kind of biases. That's just not how real life applications work. So let's jump right into the code. As I mentioned in the introduction, most backtests just lie, even from people in the industry or in academia. They just publish their best work by data snobbing, if they know it or not, or by just introducing hidden biases, just as the look-ahead bias, survivorship biases, or data biases by not cleaning up their data correctly. Also, a lot of people just don't introduce trading costs, which is a very costly mistake if you go live, because you have to pay those trading costs. And if you have a high turnover strategy, those trading costs will eat into your profit a lot. Another known issue is just Python. With the introduction of all those code assistants and LLMs out there writing code for people, it is very easy to write your own backtesting code. But most of the time, that code is not very stable and it introduces unrealistic assumptions. In the real world, that's not how it works. Real world is you are putting your own money in, so you want to make sure that your backtest is actually correct. You want to trust your results, and that's why we at Code and Capital built a backtesting engine that helps you do that. We verified the code line by line and made sure that we don't introduce those biases we go over now. Let's start by looking into the look-ahead bias. The quintessence of the look-ahead bias is that the backtest must always respect the clock. What do you know at each point in time? You want to make sure that you're not using tomorrow's data already on today's date. A look-ahead bias is exactly that. You use information you didn't have yet. It creates performance that is literally untradeable. A common leak here is, for example, using today's close in your signal. A good example here is the momentum strategy. What if you know Apple went up 5% today? Your momentum signal most likely picks up those 5% and adds Apple into your momentum signal. In real life, that is of course not feasible. Your signal does not know that Apple made 5% today. It only knows it on the next day. You want to be very sure that you don't incorporate future information, producing impossibly good simulations. To fix that, you have to lag your inputs, use point-in-time data, and align your timestamps. We at Code and Capital did all of that for you. So let's look at a real-life example first. We introduced a momentum strategy in this example here. You can clearly see that at the unbiased version versus the biased version, they divert by a lot. And that is only a 5-month backtest. We introduced a strategy that trades the top 50 names, one time without the look-ahead bias, the second time using a 1-day shift. So even though the strategy only knows 1 day ahead, it already produces, and you can see that in the stats down here, a 7% swing and almost doubles the Sharpe ratio. You can see the big impact a little data error has by just shifting your trading or your close date by 1 day and allowing your strategy to use that 1 day. Next, let's talk about the survivorship bias. Survivorship bias incorporates only testing the winners. Survivorship bias basically means that all the losers disappear from your dataset. That could be delisting through bankruptcies, it could be mergers and acquisitions, and you just drop those names and act like they never existed. Closely related to the survivorship bias is the index bias. Index bias is just using current index holdings, for example for the S&P 500, and assume that those index holdings hold true a year ago, 2 years ago, and so on. So you're not building a history for returns, you're just taking today's date and test your signal based on today's data. Backtest can't really work that way. You have to incorporate all those names that vanished at some point in time. Going back to our code base, we run a quick test here on using the actual S&P 500 data versus only today's data. You can see even in those 5 months, we get a slight bias by not using all index holdings at those point in times. We got a swing of almost 0.5% by not incorporating companies that left the index in between our trading period. Another well-known bias is the portfolio construction bias. A backtest at each point in time must respect the market. How do orders actually fill? Can I get the whole lot that I want to buy? And of course, you are constrained to your cash, to leverage, and to sizing. One example that we can look into is the following. The momentum strategy that we ran is weighted by market weight. You can now see that Nvidia in our strategy picks up 28%, Google picks up 11%, AVGO, Broadcom picks up over 10%. Most of the ETFs out there are restricted by having a max position size of 10%, 5%, or whatever you can find in their prospectus. We want to make sure that we fill all those requirements. So we ran a strategy here that basically goes against that bias by allowing Nvidia to have 28%. We restrict each name to only have 10%. You can see in our backtest here, this actually benefited our strategy. Our limited backtest actually outperformed the unlimited one. So you can see not all biases are always bad. We can here make or get more. We can get more return for our strategy by actually limiting the weights. Another big error that people make is a corporate actions error. One bad split or dividend adjustment can ruin your whole math in the backtest. For example, let's assume Apple splits 2-1 on a given date. We can say Apple started trading at $100. Now you get a 2-1 split. So all of a sudden, Apple's stock price jumps to $50 and you have 2 stocks in your portfolio. If you just mark Apple at $100 at the open or at the close of last day, and now you have it at $50 the next day, you would think that Apple just lost 50% in one trading day. A split not handled correctly can look like a 50% crash, triggering by the dip signal or whatever signal you're trading. The same stands for symbol changes, mergers, and delisting. Those all have to be handled explicitly. A good example here is Meta. better known as Facebook, that changed their ticker a couple of years ago from FB to Meta. If you don't incorporate those information and a new company now gets listed with the ticker FB, you could be very well using that new FB security in your backtests instead of Meta that you actually want to trade. In one of the prior videos, we've shown you how to pull all the data that you need into your own database. In one of the future videos, we will show you on how to merge those tickers that we use there into an actual security master so that you don't have to use tickers which introduce those issues that I just mentioned. What if a new company IPOs with the ticker FB and you don't know if Facebook or Meta or that new company are in the index? Another bias that a lot of people introduce, and I would say that is probably the most common one in academia and industry, is just not talking about costs. A backtest must respect frictions, being it spreads, slippage, and trading fees. Costs are not just a rounding error, especially with a high turnover strategy, just as our momentum strategy that we set to daily trading. If you stress test your code, you want to for sure add several different trading transaction methodologies to see if your signal still survives after trading costs. Looking at our signal, we can compare the gross versus net strategy returns. In gross returns, our strategy looks very good. It returned almost 5.5 or more than 5.5% in our 5-month backtest. If we account for trading costs, our strategy all of a sudden only returns 2%. That's a huge swing. Why is that? Because the strategy trades daily and has high turnovers. We added a trading fee cost of around 2.5 basis points per notional value traded. And you see, that is a very normal assumption on real markets, and you see the impact it has on our actual trading signal here. The last bias that we will go over is statistical in nature. First here being overfitting. Overfitting is optimizing to noise that most likely won't repeat. You're changing your parameters of the strategy so that it fits the data perfectly, but even though that data most likely will never return or never repeat that way again. A big one is data snooping, also called p-hacking. Data snooping is basically trying hundreds of variants until something works. It is basically reusing the same data until it works. The more variants you try, obviously, at some point you will find one that will work, and it's most likely a fluke at that point. If you test hundreds of ideas, at some point you will find a significant one, and that might just be by chance, not because your signal actually works. You should for sure constrain your degree of freedom in researching, and you should log every trial and don't just delete and never talk about the ones again that you tried and that didn't work. When you use one dataset repeatedly for your model selection, just good results might simply be luck and by chance and not because your signal is great. Another one is you don't want to cherry pick your periods, being, for example, you test a momentum signal just in bear markets or bull markets, depending on what side you're on. You always want to test it over a longer period of time and check both ideas. The last one we're going to talk about is the out-of-sample testing. You want to make sure that you don't test and train your signal on the same data. You most likely want to use some kind of walk-forward analysis, and if your signal swings a lot, depending on your window, it most likely is very fragile, so you probably don't want to trade on it. One example I brought here is just our momentum signal again, where we introduced 5 different momentum signals and we just played around with the parameters, so we did some p-hacking here. And by chance, you can see for some of them I just changed the look back, being not a year anymore. Now we want to look at 6 years. We changed the lags to be like 1 month or don't have a lag at all. And we also could change how many stocks we select. In our default strategy, we selected the top 50 momentum securities, so the 50 securities that in our look back returned the highest amount. But we could also change it to 25, to 50, to 100. So I just added 5 different strategies based on those different parameters, and you can see they all wildly vary in their returns. Whereas our default return 5.5%, you see one even goes up to 7.5%, whereas another one almost returns negative 1.5%. So you can see by using the same signal, just slightly changing the parameters, I get complete different returns and complete different Sharpe ratios. That just underlines how important it is to note those changes and to not just forget about them. We don't want to just show the 7.5%, assuming this is our best return, so we should write a paper on it or go live with that signal. To conclude, in this video we have shown you a lot of different biases that you should avoid in your backtesting environment. First of all, kill any leakage that you might have. Don't introduce any look-ahead bias, survivorship bias, and corporate action confusion. Second, be as close as possible to reality as you can be. Account for fills, slippages, and fees and their impact on your trading strategy. Third, you should prove robustness. Do some walk-forward analysis, introduce different regimes, and as few trials as possible without p-snobbing. And always ask yourself, would I bet real money if that is the strategy I have to trade, or is it just a fluke? Disciplined backtesting won't guarantee profits, but it will dramatically reduce self-inflicted false positives and wasted development time. Once again, I can just underline, we did all that work for you and came up with our own backtesting library. You should definitely check it out, and if you have any questions about it, we are happy to answer those in the comments.